something has to come along to change that story for me to really get outright bearish. And, when you have markets that are going up and away, it's really easy to get caught up in the, Twitter crowd that kind of constantly expresses a bearish narrative on the market. There's kind of always that expression of, oh, we're going to have this huge fall off. Be really careful. Or even, in worst cases, people getting just outright bearish, saying, we're going to bet against this market. 2025 is going to be a crash year. You're going to hear that every single year. Every single year that I've been trading in the markets, people have said, you're going to have a ginormous crash next year. This next year is going to be the big one. This is going to be the big sell-off every single year. And of the years that I've been trading, only 2 years. So I've been trading since 2017. So since 2017, we've only had really 2 major sell-offs, like major sell-offs, right? This was a 30% drop over here during the COVID pandemic. And this one in 2022, when you had the inflation scares, that was about a drop of, I believe, like 28% on the S&P. Let me actually check. Okay, I'm sorry. I'm looking at the wrong chart. The NASDAQ saw like a 38%. So let's just do NASDAQ. NASDAQ was more volatile. So minus 38% on the NASDAQ in 2022. What did the NASDAQ do in COVID? It did 31. So yeah, I mean, you get my point. Big corrections in the NASDAQ do happen, but of the 8 or 9 years that I've been doing this, only 2 years have had really substantial drops in the NASDAQ. So just by kind of generally staying optimistic rather than being pessimistic, it's been better in the NASDAQ, right? So my concern here is that, again, you see a lot of people who are thinking that the turn of the calendar year is going to cause this ginormous drop in the stock market, right? That January is going to be the point where a lot of people who have been sitting on the sidelines with their positions are going to sell and realize those gains that they've had. So let me tell you guys just a little bit of a phenomenon right now that is very prevalent in the stock market world. So if you're somebody watching your stocks, you've had like 2 back-to-back 25% up years in the stock market, okay? So 23 and 24 were absolutely exceptional years. And I gotta say, it's actually kind of frustrating when you have these periods as an active trader. I'll tell you why. Who doesn't love up years when the stock market just goes up? That's great. But what is a little bit frustrating is that it feels really silly to actually trade when you have these types of years. Now, stay with me. I'll tell you why I'm still very pro trading. Look, those are exceptional returns to get passively. Think about this. If you just bought the S&P 500, or heck, if you bought the QQQ, the NASDAQ, right? You had absolutely banger returns in the stock market for the last 2 years. Now, here's the thing. If you're actively trading, I'll tell you, I'm up 19% this year in my primary trading account, my Webull account. So you can say, Nick, you dummy, you spent all that time trading just to outperform the stock market. You dummy, right? And trust me, I sometimes think about that myself. But here's the thing. This is really, really deceiving, because what happens is people start to believe that's what the stock market does. If I just put my money in it, I get 25% per year. That's what people start to believe. And then what you don't realize is that the average return, let's say the average return for the stock market is like 10% per year, right? That's also making a big assumption that the world is going to be, a relatively peaceful and prosperous place for years to come. That's also an assumption. But let's just say you do continue to see about a 10% average. That also means the 10% average that you get comes with 25, 25, yes, but it also comes with minus 15. It also comes with minus 11. It also comes with plus 3. And these are years, right? So yearly returns are not evenly distributed. In fact, they're very sporadic. So again, if I can do 19% average returns, and I don't even know that I'm shooting for that. I don't really shoot for that. I go for like 15%. If I can get 15% returns on most years, even when the stock market may go down or something like that, I'd be exceptionally happy, because again, that would be outperforming on the long term. But this year, I've made great returns in the markets, but I'm not buying and holding, right? So buying and holding would have been the best thing to do this year. If you had just bought and held the NASDAQ or Bitcoin or something like that, that was the best thing you could have done this year. But hindsight is 2020. And so there's also years where you're, again, we talked about a second ago, 38% down in 2022. So you can't just kind of say, oh, just buy and hold, that's the easiest thing. That has been a great strategy in the last 15 years, but go back to the 60s, and if you held for 10 years, you would have been break even. Go back to 2008, if you had held for 10 years, 2001, right? If you had held for 10 years on the NASDAQ and a lot of individual stocks, you would have been way in the red. So the point is, hindsight is really dangerous. The markets have gone straight up for 2 years. It does not mean that they don't have to come down next year. They could keep going up. But I do think that a 25% next year return is unlikely. So I do want to remain pretty diversified, and I want to play multiple different sectors. I want to play a lot of options things. I want to play gold, right? I want to be continuing what I've done this year, which is, again, I think that I slightly underperformed this year. Not crazy, slightly underperformed the S&P 500 this year. But over the last 5 years, I've consistently overall beaten the S&P by having kind of a portfolio approach, trading lots of different things. So anyways, really important just to recalibrate as we go into the new year. Okay, speaking of stocks, here goes the NASDAQ down 0.8% this morning. Stock market just opened up, so you're seeing a little bit of a sell-off come into this NAS move. I am long the NASDAQ, so obviously not loving that, but really I am not too worried about this. I have a position on with the NASDAQ with a stop loss here. If this market wants to chop around, I don't really mind too much, as long as it doesn't take out these lows. If it takes out these lows, I stop out and I look for a better entry down further. So NASDAQ can do what it wants today. I think it's probably going to be all over the place. I would just go ahead and say, for the record, that I don't think that this goes down 2+% today. I think that it probably chops around from here. And I would not be surprised if we get kind of this wicky looking candle in both directions. Market's just low volume right now. And I just, I think that more directional strong moves are probably going to happen in the new year rather than the last trading day. This is the last trading day for the stock market, I do believe. Let me just double check my calendar. Actually, stock market's open the 30th, so I take that back. One of the last days. S&P 500 also seeing a little bit of a pullback. I remain bullish as long as we stay above 58.30 or so. Still looks like a technical uptrend to me until something breaks there. Russell, come back into this area. Let's see how this reacts. What was support? Let's see if that does become resistance. Same thing with the Dow Jones. We talked about this level here, right? This level, potential resistance. Let's see if buyers can overcome that and start taking back that area, trade back up here, or if we do reject lower. I still, again, like I said, I like the indices long across the board. My favorite just being the NASDAQ at this time, which is, of course, pretty volatile compared to the others. Yes, the stock that I'm interested in potentially building a position in next year is Nike. In fact, this year, I've made actually a good bit of money on Nike without ever being in the shares, because I've sold a whole bunch of cash secured puts and just have not gotten filled. It's made a lot of money because the stock's been kind of going sideways in recent months. So I've made a bunch of money just selling puts, and those puts never got assigned. So I just keep pocketing the premium and doing it again. But I'm hoping that I can actually get assigned on Nike, because here's the thing about Nike. Nike, have the revenues gone up tremendously? Not magically so. And I wouldn't say that's a very impressive revenue growth chart. But unlike Apple, which is trading at very high historical valuations relative to itself, can we look at Nike and make the same conclusion, or is it going to be a little different? Hint, hint, it's going to be different. So here is Nike's price to earnings ratio over time. Notice something different here? The price to earnings ratio for Nike has actually fallen. So this stock's valuation relative to how it historically has been valued is low. People don't like Nike. People hate Nike. People think that Nike is losing the race. Pun intended. I mean, it kind of works out. And to be fair, that is true. They've lost ground to competitors like Hoka, right? So when I look at Nike, I say, okay, look, Nike is down in the dumps. Take a look at the stock price, right? Again, I know we're talking a lot of stocks today. If you're not a stock person, I understand. We will get back to other charts in just a second. But Nike's a stock that's been beaten down real bad the last 2 years. Take a look at the weekly chart. It has lost its throne of $171 per share. It's down at 76. This share price is super beaten down, right? So longer term, this is a powerful brand that I think has a stronger probability, not a certainty, of going up than down. I like the company. They also just switched out the CEO for an insider who they believe could turn the company around and change some of the things that were missteps by most people's standards by Nike. So I like the stock. It's not a loved stock. And here's the thing is I don't really like to buy stocks that everybody already loves, like Apple, right? I like to buy things when people are scared of them. And that doesn't mean that Nike can't go much lower. Nike could be trading next year at $20 per share. It could get crushed. That's why I'm not going all in on Nike. It's just one of the stocks that I like. I think the valuation is a lot better. It's still a high valuation at 25, don't get me wrong. But Nike's had valuations in the past of 40s and high 30s. So if it restores its presence at all next year, it could very quickly, be a very strong performing stock.
So this 2022 top, which would have been November in the QQQ or the NASDAQ and January in the S&P, it did take around 2 years to get back. Because from 2022, this would have been January of, January of 22. And then over here to revisiting that high, that's January 2024, right? So we were in a 2-year drawdown, right? But as we got into 2024, all-time highs, momentum begets momentum, all-time highs. So I just look at this chart for a second. This chart looks pretty clean on the technical side. If we can't hold these all-time highs and we pull back to, I don't know, let's say the election levels, let's say anything lower than that. I mean, you can see on this weekly time frame, this market would be pretty well supported down to around 530 or so, right? And that's a pretty big sell-off. I mean, if we had a market that was going to drop from highs around 609 down to this level, let's say around 540 or so, that's a 10% correction. Okay, that goes right back to the daily time frame of where do we see some dynamic levels. Well, right now we still have, we're clinging to these highs. I wouldn't necessarily say like this is a topping pattern, but it certainly can become one very quickly. And how does it become a topping pattern? If there's a lower low, right? I mean, that's more of like a, well, I told you it was a topping pattern, but I'm not going to call the top, and the reason why is if this election stuff is still going to hold Okay, if these levels with the FOMC sell-off and that PCE news low from last Friday, if that's going to hold, then this is a false top. Okay, but if this market goes high, low, lower high, lower low, and pulls back into the 100, the 144, or the 200, which I've been saying now for over a month, you got to watch the bar count situation on the SPY. It's getting up there. We're nearing 300 bars on the daily. We've got Nvidia and Meta and several of those stocks that are stretching out to 400 plus bars. That's a long time without hitting and balancing the market at the 200 moving average. Okay, so if today is doing some serious damage, which it seems like it is it enough to have some follow through, or is next week right before New Year's and going into New Year's in the first little chunk of time in January? Usually it's a pretty bullish window. For December 24th into January 10th is usually a pretty bullish window. All of December into the first part of January is usually a pretty bullish window. Okay, so anyway, I would say this. If you remember the session I did last week, I shared a lot of things. Let's go intro to options, little kind of reference guide that I always keep, and I've been building this over the years. So let's go all the way down here. I talked about this. I don't know if I did it in this session or I did it one of my final hour sessions on YouTube, but bull market on borrowed time. So folks are too bullish. Sentiment is too frothy. The extremes and the risk appetite is just, it's too much. And when everyone's leaning on one side or the other, it can be a problem. You're taking my car, right? I don't know, but okay. So sentiment's extreme, right? And the scary stuff is that we've got crazy amounts of expectations. We have crazy amounts of risk appetite. We have crazy amounts of sentiment that's pegged to one side. And you're also getting a lot of levered instruments that are also back up towards the extremes we saw back in 2021, 2022. Okay, sentiment is stretched. Positioning is too bullish. Leveraged stocks are back up to the highs we saw back in 2021 and 2022. Everything is pegged to the 100th percentile of risk appetite, right? Most folks, household-wise, are not exposed to equities like they've been. They're just dumping into equities. So it's crowded. It's a crowded trade. It's crowded at the top. It would make sense for the market to ventilate. It makes sense for the market to just, let the air out a little bit. Let's find some more realistic levels to rebuild from. And the scary part is, yeah, it can be a little bit exhausting to see like, oh my gosh, we're going to go 10%. Yeah, maybe we do. But is that a 10% level that the market can build from? And they get back to highs again. And I said this, I would rather see this market go high, low, lower, high, lower, low, and whatever it takes to give me like a correction towards this 200 moving average, or find some structure in here and see if that area, let's just say SPY, I'll call the numbers here. Let's say SPY around like 550. 560 to 550, I'd say that's a really attractive level. Now, I don't know if we're going to get there, but if we do get there, to me, longer term, okay, give myself 5 years. I'm getting a decent discount, right? So do I have enough cash to, get some in at a 10% correction? Yes. If it gets worse, do I have enough cash to get in at a 20% correction? Yes. If it gets worse, do I have enough to get in at a 30% correction? Yes. Because the whole time this is falling, I'm going to be protecting, right? I have hedges. I have collar trades. I have long puts on my own positions that are helping me protect my stocks. So I will still have plenty of cash to then add at discounts. And if it takes another 12 months to get back to all-time highs, and I get that discount, and I get that discount, and I get that discount, there's a lot of money to be made. And that is where a lot of profits and wealth is generated, is having the ability to really take advantage of dips that the market has. Let's go through the basket. Dollar CAD, I'm still long. Still looking good to hit my profit target towards 44.80. I mean, I'd like to take this all the way to 46. I'm just not trying to be greedy. I've got 7 positions in and heading up to my profit target. Dollar Swiss, I'm also still long. I'm adding some buy stops up here. I did that yesterday. So I added in a market order, buy stop, trying to get to 9,200. That's my profit target. That's going to be about 27 positions for profit. So I've been building this thing for a while, and that's a really nice profit target, so I'll take it. So I'll watch those two. That's dollar strength. As far as other currencies go, Aussie CAD, I'm still going to wait on. Aussie Swiss and Swiss in general, I'm still waiting on positive swap. I'm willing to dollar cost average in lower on Aussie Swiss, CAD Swiss, New Zealand Swiss. Euro Swiss is still looking pretty good right now. I'm looking for Euro Swiss to stay bullish. In fact, let me do this. On my TastyFX account, I got a bunch of trades in. I'm going to start stacking some orders in here. So let's go like 95, 95, 50, 96. I'm going to stack some orders in here and put this in for the pulver alerts. I'm going to go probably like 95, 95, 50, 96, 96, 50. Stack in some orders. Revisit these lows again if possible. This might be something that builds like this. Like maybe it's choppy, right? Maybe it's choppy and then it's a falling wedge. And then when it breaks out, it starts to move and it moves quickly all the way back to that high. So that's what I'm watching for, and I want to have some orders ready to go. So these are profitable. If I can build lower, then these will be profitable, and I'll stack in some more positions on Euro Swiss. But I do like this trade all the way back up into this inefficiency zone, as well as a sweep of this high at 99. I think parity is a great spot to get back to as well. Okay, pound Swiss. Still hanging on this one, trying to get back to, I'm trying to get back to 119, 119.50. That's a long-term target, but I'm still profitable on all my add-ins here if I get to like 1700. New Zealand Swiss, same thing on Aussie Swiss. I'd be willing to add in at the flash crash low from August, and then stack my way back up, try to get into, I'd say this would be a good profit target here, and a run to this high. So profit 1, profit 2, if we come back to the same low. All right. So there's plenty of opportunity, running into the way that I trade Forex, which is slow, methodical, strategic, build small, and eventually take like big fat profits. It's not the sexiest way to trade. Traders that want leverage and they want their, I only want to risk 20 pips today. Well, you're not my trader. I'm a trader that uses Forex to trade big areas, build positions up to the size that I want, drawdown risk to me as percent in dollars. And then I usually double, triple that. So if I'm risking, let's say $1,000 in drawdown, I generally can turn that into $1,500 or $2,000 plus in profit. And so I do a lot of that on these higher time frames. And so I'm really picky about what I trade. I don't like to just throw trades in because I just follow one currency pair pretty closely. No, it's not my style. So look, my evolution of Forex trading was 1 minute chart day trader to literally swing trading, position trading like I do now. And I'm way more successful that way. I don't have to have, day-to-day grinds. It's not like getting stopped out and hunted all the time. It's like I just trade really small. When I find a trade that I like, I throw a bunch of positions at it. I'll throw, my dollar Swiss trade probably has 25, 27 positions. If I get stacked into those buy stops, I'll have nearly 30 orders running on that thing. But they're all getting paid. It's 30 profitable positions. They've, managed small drawdowns, but they also are confirming that price is going my way, and then ends up hitting my profit target. That's a fun way to trade. It takes time, takes patience, but those profit chunks are way, way, way worth it. Okay. All right, good stuff. Other currency pairs, that's about it. Watch the dollar basket. Be careful on the Japanese yen. I'm still staying in with the rank for some positive swap, and I'll watch my levels closely. Stock market wise, we're still down, going into the end of the week. That's a bit of a sad, I'd say the momentum has certainly waned. We're back below the, the Santa rally. So we're officially in red territory now. Doesn't mean that we can't do something better, but it means that from this close yesterday to wherever we are today, this is going to be seen as an island gap. Okay. This will be seen as an island gap. Now the bears may grab some control if they push lower. The bulls may grab some control if they push higher and fill the gap. So we have the FOMC low, the PCE news low. The bears can take a run at that. The bulls can take a run at getting back to all-time highs. We're sitting right in the middle, right? So from this high to this low, price is going to be sitting here at an island all by itself for the next week. Next week, we've got 2 days before New Year's. We have disrupted trading from the brokers. We're going to have like another 1 p.m. close on a Tuesday, no trading on Wednesday. Then Thursday, Friday, what's the market going to do? I don't know. Historically, Santa rally's been a positive thing. On average, 1.3%, but right now it's actually down. Okay? So this market is going to have to pick itself up in a pretty big way on Monday, Tuesday in order to get back into positive territory. So let's see what happens. But look, it's the year is almost done, right? Coming into a clean slate. Whatever happened in 2024, good, bad, accept it. Learn from it. Make it better. I want to make 2025, again, best year yet. 2024 has been one of my better years. As far as risk-adjusted returns, probably one of my best years. I even through that August dip, I was only down like 7%, and I'm pushing close to 40% gains for the year. That's pretty good. That's pretty good. So I'm happy with that. I've got happy clients. I think that, it's like, and again, I know I paid for protection. I know I lost on a bunch of hedges, but they paid when they had to. They paid in April. They paid in August. So far, it's like I still have hedges on the Qs. If the Qs drop to 510, I'm getting a $23 hedge that I paid $6 for. So there's still some potential like hedge profits that help me offset, and then I'll see what the rest of it looks like.
Did you know we do a live trading show Monday through Friday with guests from all over the world? To get notified when we go live, click the bell button next to the subscribe button or check in at 9:30 a.m. Eastern Time. We have helpful, free content in the description below and on our website, a1trading.com. Thanks for watching today's video, and we'll see you tomorrow.